Let's do 25 minutes of quick, profitable business here on Business Incorporated. And here's what we have prepared for you. The AfDB will be discussing how to replenish resources for development on the continent. Zimbabwe is forecasting big. 6% is the forecast for its growth. Kenya and Uganda have signed a deal to boost cross-border trade. You're welcome to the program. I'm Ini John Mekwa. We have just 25 minutes, so let's go on it now. Starting from the global space, oil prices were just a little change on Friday, heading for a weekly gain as investors, of course, are weighing the impact of those tariffs and sanctions by U.S. President Donald Trump. So we see $71.52 for Brent, down 0.31%. WTI is also down 0.26%. $69.08 a barrel. Prices stabilized on Friday after losing more than 1% in the previous session. However, for the week, Brent is on course for a 5% gain and WTI about 6.6%. Trump signed an executive order on Thursday imposing tariffs ranging from 10% to 41% on U.S. imports from dozens of countries. Nigeria included. Nigeria is in the category of about 15%. So Canada, India, Taiwan, they failed to reach trade deals by 1st of August deadline. Partners have managed to secure trades, including European Union, the South Korea, Japan, and Britain. Prices were also supported this week after Trump threatened to impose 100% secondary tariff on Russian crude buyers in a bid to pressure Russia into halting its war against Ukraine, and that stoked concerns of potential disruption to oil trade flows and the removal of some oil from the market. JP Morgan is saying that Trump's warning to China and India penalties on their ongoing purchases of Russian oil potentially put 2.75 million barrels per day of Russian seaborne oil exports at risk. And the two countries are the world's second and third largest crude consumers, respectively. Going to metals now, gold prices held steady on Friday, but is poised for a third consecutive weekly loss, pressured by stronger dollar and diminished expectations for U.S. rate cut, while uncertainty from the tariffs on trading partner offered some support. So look at the numbers. Spot gold is unchanged, $3,288.89. U.S. gold, beg your pardon, is down 0.3%. at $3,339.90. Spot silver is down much more than that, 0.6%, $36.49. Platinum is down 1.4%, $1,280.90. Palladium is down more than 1.5%, $1,187.50. I guess this is expected, seeing that today is that August 1st that we've been counting down to the tariff start today. Everybody who is interacting with the United States is involved and affected. You have one level of tariff or the other. So, of course, this is why we see this red color with the metals. Coming back home, the average retail price for refilling a 5 kg cylinder of liquefied petroleum gas, that's cooking gas, went up by 1.92% month on month, from $8,167.43 in May to $8,323 in Naira in June. These figures were disclosed in the latest report released by the National Bureau of Statistics. And the report also says the average price of 5 kg rose 1.93 on a year-on-year basis. This marks a 19.49% increase from what it was in June 2024, which is $6,966.03 kobo. Delta State recorded the highest average price at 9,243 naira 38 kobo, while Oyo had the lowest at 7,100. Average price of 12.5 kg of cooking gas went up 1.46% to about 21,000 in June, compared to 20,709 in May. This indicates a 33.52% increase year on year, and the average retail price of refilling 12.5 cylinder of liquefied petroleum gas increased by 2.18 on month-on-month basis. About 2 months after the federal government banned all ministries, departments, and agencies from procuring foreign goods and services that can be made here in Nigeria, the Office of Made in Nigeria Project Office, led by Executive Mr. George Nwabweze, says that the new rule is catching on slowly. Mr. Nwabweze was aghast on Business Morning earlier today, believes that implementation of the Nigeria First policy is a long-term project which they are determined to see through.
We, on our own side, Made in Nigeria, have also started something like that. There is a Made in Nigeria, Wear Nigeria, which we are already setting up a structure on that. There are some other liaising with the state government, state governors, and other activities are already started in place. We believe that gradually we get there. It's not something you have to put in immediately and start changing it immediately. It's a campaign, and it's a long-term campaign, and it's a lifetime campaign. So it has to take gradual process, because if you are telling somebody who is wearing Italian designer or maybe one foreign designer to start wearing a locally made product, it needs to take a process, and that process is what we are currently doing now. So we believe that gradually the campaign will get from up down to the grassroots, and we'll get it right. So we are doing it, and we are doing it gradually. It's not something we have to rush.
That was earlier today. Now let's head straight to the markets now and look at the continuous bullish run in the Nigerian market. The market opened green. The all-share index went up. That's about 11 a.m. 57 basis points. Haven't traded flat earlier. Boa Cement, we see, gained today. And also yesterday, the market movers, UACN, following the acquisition of Chivita from Coca-Cola, we saw them gaining the trust of more investors. So they were top gainers yesterday, as well as Wema Bank, and they're still keeping that on today. So for intraday numbers, about an hour ago, though, we see that the prayer that I did yesterday during the stock market report seems to have been answered, because we have hit the 140,000 and heading to 141. So this is about an hour ago, and the market was positive then. I wonder if we have hit that 141, but I mean, that before the stock market report. Intraday numbers still green for the NGX. For Johannesburg, it's on the flip side. It's down 1.32%, 97,218.08 for them right there. If we can have other markets, Egypt is closed today, but yesterday they closed in the positive, 34,198. Nairobi is deeply in the red, but I mean, they've been doing good. That's talking about Nairobi. I think they're moving close. I mean, the momentum seems to be going along with what we have in the NGX, as well as Johannesburg also. These are the three major markets on the continent that are doing so good at this time. So the NSE of Nairobi closed Thursday more than 2% in the red. Let's have a move over now to the Middle East and see two markets trading there. Dubai and Abu Dhabi, they are in the red this afternoon, 6,106.24. Abu Dhabi is also in the red. The other markets are not open on Fridays, but we see that they closed positive on Thursday, Tadawul and Qatar. Moving over now, let's go to the United States, where the action is coming from and hitting every part of the world. The market hasn't taken it easy, expectedly, because, I mean, it's tariff day, so investors are not very convinced or certain as to how the world will react to all of this. So we see the Dow Jones down more than 1%, the S&P down more than 1%, NASDAQ also down more than 1%. You know, this is closely followed by that rate cut that was not announced. Remember, the Fed decided to hold again. So all of that feeding into this. I guess by next week we'll see more of stability. By then, countries will be getting used to the new tariff, and investors also will follow suit. I think the dollar also, it's recovered, because on the day of the Fed, the dollar went down, but we see that it's beginning to recover. That's the last report that we had today. So for the U.S., most of the markets are in the red. Let's see what's happening in Asia. We see Asia is not different, closely related. Sentiments are really closely related there. So we see the Nikkei is in the red, 0.66%. Kospi is closed today, but closed yesterday deeply in the red, 3.88%. and then the Hang Seng also in the red. Of course, we know, like for instance, the Kospi South Korea has been able to get a bit of relief in the tariff. I think they have about 15% now instead of about 30%. Let's see other markets on the continent. The Shanghai is also in the red, 0.37%, as well as for India. India, obviously, they have a deal, but they also have, something hanging over their head, which is their transaction on Russian oil. That could give them extra tariffs, except something is done. And I wonder how India would survive without Russian oil. I wonder how India would survive without it, because even at the peak of the war between Russia and Ukraine, when there were so many talks about sanctions and secondary sanctions, India was deeply dependent on Russian oil. So I wonder if they can do without oil, Russian oil at this time, and if President Trump will decide to turn a blind eye to that. Time will tell all of that. So it's all red for the Asian market at this time. Now, still talking about market, let's see what's happening in Europe. We have Vada now joining us to tell us what's happening there. Hi, Vada. Happy Friday to you. How are the investors reacting after the new tariff regime has been announced?
Hi, Ini. Happy to be here. It is a red Friday, so to speak. I just saw that it's the same for the rest of the world, but also here, DAX, Euro Stoxx 600, Euro Stoxx 50, everything is in the red today. And it seems this trend will continue until markets close. There are a few winners within the DAX, and one of them is pharmaceutical company Bayer AG. They've seen big gains today, but pretty much most other companies on the DAX are suffering. Denmark's Novo Nordisk shed 4.9% earlier today and has recovered only a little bit since then. So it's not looking good for European stocks. And what we're seeing is a 4-week low at the end of a busy week as investors probably process the tariffs, including the new 39% one on Switzerland. Eyes are also on the payrolls data coming from the US that's meant to come out later today, and also keeping a check on potential cut rates or decisions or signals from the ECB.
So I hear energy crisis is the buzzword there in Germany because after the war started in Ukraine caused by Russia, EU mostly had to lose or reduce dependence on Russian energy and move over to Qatar. Now, Qatar is saying they want to pull out. What's going on?
Yeah, the reason is a new EU accountability law, and its aim is to fix global supply chains, meaning ensuring that no unethical practices occur from the raw material stage all the way to the end finished product. Now, unethical practices here mean environmental harm, human rights abuses, or child labor. All of this should be avoided throughout the whole production process. Now, this new EU directive also pushes companies to make climate transition plans with the Paris Agreement. Now, this is what the EU wants. And it's a lot to take in for energy-heavy Qatar. Doha says that this particular directive goes beyond normal objectives set in the Paris Agreement, and that this kind of threat of high fines and penalties will be a big risk for Qatar Energy, which is the world's biggest LNG producer. And so it threatened to pull the plug on planned LNG deliveries starting from next year.
Wow, that is scary. So what's going to happen? What could happen?
Well, Europe and Germany have relied quite heavily and significantly on Qatar since Russia's war in Ukraine. And so close to 14% of the bloc's total LNG needs have been met by Qatar since 2022. Any kind of disruption to this flow would trigger a big surge in energy prices in Europe and especially in Germany. And it's not just Qatar that has a little bit of an issue with this new EU directive. Other industry groups within Europe and Germany have voiced concern and lobbied aggressively against this directive in the EU. And so after a lot of aggressive lobbying, and this was led also by Germany, France, and Italy mainly, the directive has been put off until 2028. But it's still on the cards, hence the threat from Qatar. I think Germany will do its best to avoid any confrontation with the Middle Eastern country. Deals inked at the time, in 2022, like this one with Qatar, were lifelines for Europe and Germany and helped fill big energy gaps. And if for any reason Qatar can't supply energy to Germany anymore or refuses to do so, this would be a big blow to the government and energy prices here.
Obviously, and we hope we don't have to get back to, the conversation of energy crisis in Germany or any of the EU countries. So thank you so much for bringing us up to date and have a great weekend.
You too. Thanks for having me, Ini.
All right, now let's come to Africa, where the African Development Fund is a concessional lending window of the African Development Bank Group. It provides low-income African countries with grants and concessional loans to support poverty reduction and economic development. Now, we're talking about resources for development, and global finance aid continues to decline. That's no longer news, and experts warn of increasing risks that's posed to low-income countries. Let's find out what AfDB is planning to do about this. We'll be speaking right now with the Division Manager, Resource Mobilization and Partnerships at AfDB, Ms. Valerie Dabadi. Ms. Dabadi, good afternoon and welcome to the program.
Thank you so much for having me.
Yeah, so Africa has been really loud recently, talking about how they can depend on themselves and they have the resources and all of that. So I guess we shouldn't feel the impact of a cut in international funds and aids, right?
I wouldn't go that far. Let me start off by explaining a little bit what the African Development Fund is and its relationship to the African Development Bank. The African Development Fund is part of the African Development Bank. The bank itself is a AAA rated institution and the leading development financier in Africa. We have two types of financing: the market rate, which is the African Development Bank, and a concessional financing window, which is the African Development Fund. It provides very cheap loans and grants to about 37 of Africa's most challenged, if you will, countries on the continent. I would say that the repercussions and the reverberations and the landscape, of course, are affecting us. Because, as you said, official development assistance is actually expected to decrease. It's supposed to go down by 17% in 2025. And of course, that makes it a difficult situation in which to fundraise. By fundraising, I mean that the African Development Fund is currently looking to raise resources for what we call the 17th replenishment. It's there on 3-year cycles, and over 2025, we'll be aiming to raise funding from a core group of shareholders, about 27 or so, of which Nigeria, of course, is important to us, but it is not yet a member of the African Development Fund. It is, however, the largest shareholder of the African Development Bank, and I think a standard bearer for us.
Yeah, I know Nigeria is the largest. That was celebrated at your last AGM. Where you held in Abidjan, and I was privileged to be there. So if Nigeria is the largest contributor to the bank generally, and now you have the ADF, should we get Nigeria to also be the largest? But what are we have countries like South Africa, like the most, highly developed on the continent. What are they doing, putting these resources together for the development of the continent?
So it's a very good question. Let me start by how the African Development Fund is set up and who its shareholders are. It's principally actually owned by non-African countries, with Angola being the only full state participant. And what I mean by that is that they have gone through the legislative requirements to join the fund and participate on a regular basis. However, this does not mean that African countries do not participate in the African Development Fund. You've mentioned South Africa, and South Africa actually is a regular contributor and I think a very vocal supporter of the ADF as well as of Africa's development. And in the last replenishment cycle, we had for the first time contributions from Algeria and Morocco. We had pledges from the Democratic Republic of Congo. And for the 17th replenishment, we actually have pledges from the Anglophone West African countries, including Gambia, Sierra Leone. We have from Sudan. We also have from Benin. So I think it's a very positive trajectory in terms of support of African countries for the ADF.
And on your 17th replenishment fund, who should contribute, who is not allowed?
So everyone is allowed to contribute, but we currently have a charter that allows only countries, if you will, to participate as state participants. We can, however, receive contributions from non-sovereigns, non-countries, and we're working, if you will, on that. We do work with, let's say, foundations. We do work with other development organizations. For the time being, our charter doesn't allow them to become state participants. I think it's a very good segue to talk about the charter as well, because we're going through something which is very important for the ADF, and that is looking to change its charter to allow it to borrow and to lend on non-concessional resources. This may come as a surprise, but the ADF, since it was started as a concessional financing window, we couldn't really fund ourselves or give out loans or resources that were, let's say, market rate. What we're hoping to do right now, and this process is ongoing, and I also wish to thank Nigeria for having approved the amendment to the charter. The charter will be changed such that it will allow us to access a new way of financing, and this will be through the capital markets. The African Development Bank has been doing this for quite some time. The African Development Fund, however, has not. It will potentially allow us to raise an extra US $5 billion every replenishment cycle, which will make a big difference in the way that we can, one, fund ourselves and also be able to service our clients. $5 billion for replenishment. The last replenishment, which was nearly $9 billion, I think is an important thing.
I believe that's necessary too, seeing that the world is changing now and Africa actually has to fund its development and not depend so much on foreign development. Thank you so much, Valerie Dabadi, Division Manager, Resource Mobilization and Partnerships at the AfDB.
Thank you for having me.
All right, now to other stories. On the continent, South Africa will need around 4 trillion rands by 2035 to address infrastructure challenges affecting the country's energy sector. That's according to the country's Deputy Finance Minister, Dr. David Masundu, who says that the funding gap is too large for government to fill alone. He was speaking at the Sandton at the launch of the Integrated Resource Plan held in partnership with the National Treasury. We're still in South Africa, where the trade balance widened to a preliminary surplus of 22 billion rands in June. That's up from downwardly revised 20 billion in May, according to data released by the SA Revenue Service. This means SA exported more than it imported in June, with the surplus growing slightly, even though exports declined. That's because imports, including petroleum oils, smartphones, and crude oil, fell more sharply than exports. Key exports include vehicles, mineral fuels, gems, and precious metals. Intra-African exports are significant, with Mozambique, Botswana, Zimbabwe, Namibia, Zimbabwe, and Zambia being major destinations for South Africa. And of course, we're still on the continent. Now, Uganda and Kenya have signed a landmark agreement to deepen cooperation on standards, conformity assessment, and metrology aimed at eliminating trade barriers and enhancing product quality across the region. The Memorandum of Understanding, signed on July 30 in Nairobi by the Ugandan National Bureau of Standards and the Kenya Bureau of Standards, was witnessed by President of Uganda and that of Kenya. The deal is expected to facilitate greater market access, boost industrial development, and align national quality frameworks with international standards. And then we move to Zimbabwe, where that country is on track to achieve a forecast 6% economic growth this year, 2025, helped by good agricultural output and strong commodity prices. This is according to the finance minister. The Southern African country's economy has shown signs of recovery in the first half of the year, following a severe drought and currency turbulence in 2024 that pushed the GDP down to 2%. Well, he didn't give any update on the budget deficit, which was seen at 0.4% of the GDP in 2025 during the budget forecast. But Zimbabwe's fiscal position remains under strain from grain imports drought relief spending, and the public sector wage bill, while the government has collected more revenue than in the same period last year. Analysts are saying that the deficits may prove difficult without new fiscal measures. And that's it on Business Incorporated. Thank you so much for being a part of this quick, profitable business. We'll do this every day next week, God's grace. I'm Ini John Mekwa. I'll see you tonight at 10.